Welcome to Real Estate Edge with Raymond, your go-to source for smart investing tips and market insights. Whether you're new or a pro, we'll help you stay ahead in the real estate game. This podcast is the ultimate guide to making smart financial decisions. Each week, we will do a deep dive in what is trending in the sector. Let's dive in.
Hey everyone, welcome to another episode of Real Estate Edge with Raymond, where we give you the tools, insights, and strategies to stay ahead in the real estate game. I'm your host, Mark, and joining me is the man with the plan, Raymond Ramos. Raymond, how's life treating you?
Hey, Mark. Life's good, and I'm pumped for today's topic. This one's going to open some eyes.
Same here. And to help us break it all down, we've brought in an expert on strategic asset structures and real estate protection, Kevin Brunner. Kevin, welcome back to the show.
Thanks, Mark. Always a pleasure to join you and Raymond. And this is a topic that I think can really transform how people approach their real estate holdings.
Let's start simple. Kevin, give us the elevator pitch. What is a holdings trust?
A holdings trust is a type of a business trust where a third party, called the trustee, holds legal title to an asset, like real estate, for the benefit of someone else, called the beneficiary. So you're technically not the owner on public record, but you're still the one benefiting from it.
And that's the magic of it. You've got the protection of having your name off title, but you still call the shots and benefit from appreciation, rental income, eventual sale profits, and tax deferral.
So, from the outside, someone might see the property as owned by a trust or trustee, but you're still in control behind the scenes?
Exactly. Think of it like a shield. It gives you legal distance between yourself and the asset while still retaining control and benefit.
Let's go a little deeper into the legal structure. Who are the main players in a holdings trust?
There are three key roles. Grantor. This is the person who creates the trust and puts assets into it. Trustee, the person or entity who holds legal title and manages the asset. Beneficiary, the person who receives the financial benefits from the asset. The trust agreement lays out exactly what the trustee can and cannot do, and when and how the beneficiary gets distributions.
And let's be real, you don't want to cut corners here. A missed goal in the structure can lead to unintended results, so you need a true expert to guide you through it.
Okay, let's get into the real-world perks. Raymond, what's the number one reason for clients to set up a holdings trust?
Hands down, asset protection with tax advantages.
Right, and I'd add privacy. In some states, anyone can pull property records. Do you really want your name on 10 different properties for the world to see? A trust keeps that information private, and for long-term thinkers, it's a great estate planning tool. Your kids or heirs don't have to go through probate court.
And as already mentioned, tax advantages. You can minimize estate taxes or defer capital gains, especially if you're into multiple deals in assets like real estate.
Can you give us more details? Kevin, you shared before the show that you have set up a lot of holdings trusts. Will this also work for foreign investors?
Yes, the holdings trust makes it far easier to work with U.S. banks, foreign-sourced funds, purchase and financing on properties. We do this all the time together with customized installment sale strategies and a dozen or so other options. Each property is held in an LLC, professionally managed by a trustee, and each LLC is owned by the holdings trust. The foreign owners or investors are partners in the holdings trust. They do not have to be on each LLC as those are wholly owned by the holdings trust. The trust is managed by the professional and fiduciary trustee. This makes U.S. tax filings far simpler for a foreign investor. Bank dealings are far simpler as well. And of course, overall taxes are lower. And although foreign owners cannot use 1031 exchanges to go between properties, the trust is not bound by the limitations of 1031 exchanges while deferring gains taxes from one deal to the next again and again. That is a really good advantage. This makes the holdings trust a far better method of securing investments, management of investments, moving between investments, raising capital, borrowing for properties, tax and wealth strategies.
As a side note, the best fiduciary services can even offer additional benefits like preferred terms and deal sourcing where fees for their full service are about 30% or less of the taxes saved much less what those taxes earn by being reinvested rather than being paid out to Uncle Sam. The best fiduciaries are those who have a long track record with 0 IRS audits because they follow IRS rules.
Let's talk about action steps. Kevin, how does someone go about setting up a holdings trust?
Start by meeting with a professional tax strategist and financial expert who specialize in relevant tax and trust law. You'll define the purpose of the trust, the assets going into it, who the trustee will be, who the beneficiaries are, and what happens if you become incapacitated or pass away. Once the trust agreement is drafted and signed, the assets, like property titles, are legally transferred into the trust.
And don't forget insurance. If you're holding rental properties in a trust, make sure your insurance policies reflect that structure. It's a small but important step.
All right, guys, let's do a lightning round. I'll throw out a quick question, and you give me a short answer. Ready?
Let's go.
Sure.
Can I change the trustee later?
Yes. Create a revocable trust so the grantor can change the trustee.
Can I sell a property that's in the trust?
Yes, the trustee only needs to be instructed to do it. The trustee can only follow the instructions given to him. He can't even get paid without expressed instructions. Control is the key word in this scenario.
Will this protect me from all lawsuits?
No structure is bulletproof, but a trust creates a major legal hurdle for creditors.
Do I still pay property taxes?
Yes, same taxes, but you get an advantage in terms of capital gains, inheritance, and estate taxes.
Can I use a trust for out-of-state properties?
Yes, but make sure you comply with that state's rules. Some states have specific trust laws.
This has been incredibly insightful. Kevin, what's one final piece of advice for someone considering a holdings trust?
Get clear on your goals: protection, succession, taxes, and then work with a team to build the trust around those goals. Don't cut corners.
And I'll add, start sooner rather than later. Too many people wait until something bad happens to take asset protection seriously. If you're growing your wealth, you need to protect it now.
Couldn't agree more. To everyone listening, if you want to connect with Raymond or Kevin to explore setting up a holdings trust, Raymond's personal email is in the show notes. They've got the knowledge and the network to help you build a rock-solid foundation. That's it for today's episode of Real Estate Edge with Raymond. Big thanks to Kevin Brunner and, of course, to Raymond Ramos for dropping gold as always. If you liked this episode, be sure to subscribe, leave a review, and share it with someone who needs to hear it. We'll catch you next time. Until then, keep your edge sharp and your real estate smarter.
Thanks, everyone. Talk soon.
Take care.
That's a wrap for today on Real Estate Edge with Raymond. If you found this episode valuable, don't forget to subscribe, leave a review, and share it with fellow investors. Stay tuned for more expert insights and trending tips to grow your real estate portfolio. Until next time, keep investing smart.